You said this is nothing more than a typical bear market rally. At some point, these rallies are not going to be your typical bear market rally, and it is going to be a real rally. And it is going to mark the bottom. And it's going to be a new uptrend in stocks. I want to know, how am I going to know when that is happening? When are you going to come on and say this is not your typical bear market rally, you or anybody else? I'm not picking on you. You get my point.
Sure, I get your point. I think let's look at earnings. Earnings are at their peak. We haven't even seen the first cut, not to mention the second or third cut where someone could say, oh, it's almost done. We haven't seen the first cut yet. And if you look at where earnings estimates are today versus where they were 4 months ago, they're essentially unchanged. In that 4 months, we've had ISM, new orders to inventories, is the same level as it was in October of 2008. You have consumer confidence at the lows. You have financial conditions tightening. You have the dollar ripping, yet estimates are unchanged. Is the corporate outlook the same today as it was 4 months ago? No. So we think earnings are going to come under pressure, and this will not be the last cut. This will be the first cut. And once, just like we see in stocks, once a company cuts, there's usually a second or third cut to come. We saw that already with Target. We saw that with Restoration Hardware. And I think that we're going to see that with the broader market. Now, in terms of timing, we don't get the bulk of the earnings that are going to matter for this market are going to start the week of July 25th because financial earnings are important for financials, but may not really give us an indication. So there's a little bit of time. And so could we have a little bit of more of a squeezy market? It's possible. But I think ultimately buying the S&P right now at 3,900 when you have peak earnings, a tightening Fed, is just not a good risk reward to be long. And there's all sorts of tail risks that are out there that could suggest a much lower market. And credit markets are showing that, not only in the U.S., but also in Europe. Credit markets are suggesting that the risk right now is extremely high.
Although you've had a little bit of narrowing of spreads. I mean, I get your point, but everybody sounds the alarm bells all the time lately, it seems.
Yes, so spreads have tightened, but if you look at what's going on in Europe, those spreads have blown out far more than here in the U.S., and most of it's because of the risks around energy and their supply from Russia. But if something goes wrong there, we know that's going to have a global spillover impact. So I think that's an important fact and something to watch.
We will.
I would also say that if you look at copper, copper has sold off 25% in the last month and a half, and copper is a metal that actually has big secular tailwinds. And yet it's sold off 25%. And that is the market, the commodities market, telling you that the economic slowdown is real and it's going to last for a significant period of time. And when you look at the chart of copper.
But I mean, I hear you. I know it's always been an interesting economic indicator, if you will. But when you had commodities at such high levels and we're like, oh, my God, commodity prices are way too high. And then they come down. And now we're saying, oh, but that's now a predictive factor of economic growth. How can we have that both ways? I mean, these commodities needed to come down from extraordinarily high levels.
Yeah, so in fairness, I would say that if you look at, wheat or you look at oil, that has been much more of a supply issue that's causing the concern. Copper has never been a supply issue. Copper was trading at the highs because people had a bullish view on the economy as opposed to on the global economy as opposed to oil, which is much more of a supply issue. So, it's certainly, oil where it is right now is certainly a positive. And some of the inflation metrics coming down is certainly a positive. But I would just argue that the reason why that's happening is because of this, deteriorating outlook in growth. And equities, if the CPI comes down to, 5, 4, 3%, and the Fed ultimately in 6 months stops, but we're in a major growth downturn, that's not a favorable equity environment. And when you see the price of copper do what it's doing, that's an indication that that's a big risk of happening.